Welcome back, Econ Junkies, to Boss Economics World, the only show that turns the dismal science into a full-blown circus of financial absurdity. I'm your ringmaster of economic chaos, here to break down the latest hot mess in the world of money, power, and, oh yeah, complete and utter nonsense. Buckle up, because today we're diving headfirst into a story so wild, it's like a reality TV show, a Greek tragedy, and a Wall Street fever dream all rolled into one. Let's talk about the Trump administration's latest stunt, firing the Commissioner of the Bureau of Labor Statistics, BLS, like it's an episode of The Apprentice, and why the stock market is acting like it just chugged a gallon of Red Bull. Spoiler alert, it's not because everything's fine. Oh no, no, no. It's because the economy is a house of cards built on quicksand, and we're all just pretending not to notice. Let's get into it. Alright, folks, let's set the scene. A week ago, the Trump administration decided to yeet the Commissioner of the Bureau of Labor Statistics out of a cannon after the BLS dropped some revised data that was, shall we say, less than flattering for the White House. The unemployment rate? Oh, it's climbing faster than a squirrel on a Red Bull bender. Revised figures show it's now at 5.2%, the highest since the post-pandemic recovery began in 2021, according to the latest BLS report. And inflation? Still simmering at 3.8% year-over-year as of July 2025, per the Consumer Price Index, CPI, which is above the Fed's sacred 2% target. Consumers? They're sweating bullets, with consumer confidence dropping to its lowest level since mid-2023, according to the University of Michigan's Consumer Sentiment Index. Now, in a normal world, you'd think this would be a 5-alarm fire for Wall Street, right? Stocks should be tanking, investors should be panic selling, and CNBC should be running a 24/7 doomsday ticker. But no. Instead, the stock market decided to throw a party. On Friday, August 8, 2025, the Nasdaq 100 hit an all-time high, the S&P 500 flirted with 6,400, and Wall Street had its best week since June. What in the name of Adam Smith is going on here? Is this the Twilight Zone? Did we all collectively lose our minds? Or is there something deeper, and way more messed up, happening under the surface? Spoiler alert, it's the latter. Let's peel back the layers of this economic onion and try not to cry too hard. First up, let's talk about this BLS firing. Now, the Bureau of Labor Statistics is supposed to be the gold standard of economic data, independent, impartial, and nerdy as heck. These are the folks who crunch the numbers on unemployment, inflation, wages, you name it. But when the latest revisions showed unemployment ticking up to 5.2%, and, oh yeah, revealed that job growth over the past year was overstated by nearly 800,000 jobs, per the BLS's own preliminary benchmark revisions, well, let's just say the Trump administration didn't exactly send them a fruit basket. Instead, they sent a pink slip. Now, here's the kicker, this isn't just about one guy getting fired. This is about the erosion of trust in economic data itself. If the government can just fire the people who tell us the truth because the truth is inconvenient, what does that mean for the integrity of the numbers we rely on? Investors, businesses, and policymakers all depend on BLS data to make decisions. But if those numbers are now seen as politically tainted, we're entering dangerous territory. Imagine trying to navigate a ship with a compass that's been magnetized by a politician's ego. Good luck not crashing into an iceberg. And let's not forget the real-world impact of this unemployment spike. That 5.2% unemployment rate translates to roughly 8.7 million Americans out of work, according to the BLS. And it's not just the headline number, underemployment, which includes people working part-time because they can't find full-time jobs, is creeping up to 9.8%, the highest since early 2022. Meanwhile, wage growth is stalling, with average hourly earnings rising just 2.9% year-over-year in July 2025, barely keeping pace with inflation. So, while Wall Street is popping champagne, Main Street is popping anxiety meds. But hey, who needs accurate data when you've got vibes, right? Now, let's talk about the other elephant in the room, inflation. Oh, inflation, you sneaky little gremlin, always lurking in the shadows, ready to ruin everyone's day. As of July 2025, the CPI is still clocking in at 3.8% year-over-year, which is down from its peak of 9.1% in June 2022 but still way above the Fed's 2% target. And let's be real, this isn't just about numbers on a chart. This is about the fact that a gallon of milk now costs $4.50, up 15% from 2 years ago, according to the USDA. It's about rent prices in major cities like New York and San Francisco, which have surged by 8.3% year-over-year, per Zillow's latest data. It's about the fact that the average American household is now spending 36% of its income on housing, the highest share since the 2008 financial crisis, according to the Joint Center for Housing Studies at Harvard. And here's the kicker, this inflation isn't just a supply chain hangover from the pandemic anymore. Sure, we've still got lingering issues. Global shipping costs are up 12% year-over-year, per the Drewry World Container Index, but now we're also dealing with wage price spirals in certain sectors. For example, in the service industry, labor costs are up 6.2% year over year, according to the National Federation of Independent Business, as businesses try to attract workers in a tight labor market. Those costs get passed on to consumers, and boom, you've got a self-perpetuating inflation machine. So, why isn't Wall Street freaking out? Well, part of it is the hope, some might say delusion, that the Federal Reserve is about to ride in on a white horse and save the day with interest rate cuts. More on that in a minute. But first, let's talk about the real victims here, consumers. The University of Michigan's Consumer Sentiment Index just hit 66.4 in July 2025, its lowest level since mid-2023. That's a fancy way of saying people are stressed out, tapped out, and fed up. Credit card debt is at an all-time high of $1.14 trillion, according to the Federal Reserve Bank of New York, and delinquency rates on those cards are up to 9.1%, the highest since 2011. But hey, as long as the Nasdaq is hitting records, who cares about the little guy, right? Alright, now let's get to the part that makes absolutely no sense, the stock market. On Friday, August 8, 2025, the Nasdaq 100 hit an all-time high, the S&P 500 was knocking on the door of 6,400, and Wall Street had its best week since June. What in the name of Milton Friedman is going on here? Unemployment's up, inflation's sticky, consumers are miserable, shouldn't stocks be tanking? Well, not if you're living in the magical land of Wall Street, where reality is optional and vibes are king. According to Brett Kenwell at eToro, momentum has been strong in equities, with both technicals and fundamentals working in bulls' favor. Translation: stocks are going up because stocks are going up, and also because everyone's pretending the fundamentals are fine. Earnings have been better than expected, sure, but let's dig into that. According to FactSet, S&P 500 companies reported earnings growth of 9.8% year over year in Q2 2025, which sounds great until you realize that 80% of that growth came from just 5 tech giants: Apple, Microsoft, Nvidia, Amazon, and Alphabet. The rest of the market? Flat or declining. This isn't a broad-based rally, it's a tech bubble on steroids. And then there's the Federal. Oh, the Fed, the great savior of markets everywhere. Investors are betting big that the Federal Reserve will start cutting interest rates in the second half of 2025, with markets pricing in a 75% chance of a 25 basis point cut at the September meeting, according to the CME FedWatch tool. Lower rates mean cheaper borrowing, which means more fuel for the stock market fire. But here's the problem: if the Fed cuts rates too soon, they risk reigniting inflation. If they don't cut rates, they risk choking off growth and sending the economy into a recession. It's a classic catch-22, and the Fed's walking a tightrope with no net. But hey, why let pesky fundamentals get in the way of a good rally? As long as the economy holds up, as Kenwell puts it, the party can keep going. Of course, holding up is a relative term when you've got 8.7 million unemployed Americans, a consumer base drowning in debt, and an inflation rate that refuses to behave. But who needs reality when you've got FOMO? Alright, folks, let's zoom out and look at the big picture. What we're witnessing here is an economy that's increasingly disconnected from reality. On one hand, you've got Main Street, where people are struggling to pay their bills, businesses are grappling with rising costs, and the labor market is starting to crack. On the other hand, you've got Wall Street, where stocks are soaring, tech billionaires are raking in cash, and everyone's acting like it's 1999. This isn't sustainable. It's a house of cards built on quicksand, and the only thing keeping it upright is blind optimism and cheap money. And let's not forget the political angle. The Trump administration's decision to fire the BLS commissioner isn't just a one-off scandal, it's a symptom of a broader trend of politicizing economic data. We've seen this before, folks. Remember when Trump claimed the unemployment rate was fake news back in 2016? Or when he pressured the Fed to keep rates low in 2020 to juice the economy ahead of the election? This is a playbook, and it's dangerous. When you undermine trust in institutions like the BLS or the Fed, you erode the foundation of a functioning economy. And when you combine that with sticky inflation, rising unemployment, and a stock market that's living in la-la land, you've got a recipe for disaster. So, what's the takeaway here? For the average person, it's simple: don't be fooled by the stock market's sugar high. The real economy is struggling, and the cracks are starting to show. For the finance pros watching, it's time to start asking some hard questions. How long can this disconnect between Wall Street and Main Street last? What happens when the Fed's tightrope act fails? And for everyone, it's time to demand better. Better data, better policies, and better accountability. Because if we keep pretending everything's fine, we're all going to end up in the economic dumpster fire of the century. That's all for today, folks. If you liked this circus of economic absurdity, smash that like button, subscribe, and ring the bell for more Boss Economics World. And remember, in the world of money, the only thing more inflated than the stock market is the ego of a politician. See you next time.